Did you know that even today, after 50 years of inception, Vanguard S&P 500 Index Fund is one of the world's largest mutual fund plan with a whopping $496 billion of assets under management. It's one of the biggest funds ever in the history, pulling in more investments and more trust year after year. But wait, have you ever heard of index funds? Ever wondered what these index funds are? Are these index funds mutual fund plans or saving schemes? Who actually design these funds? What investment strategies do they hold? You have answers to all these questions with clear examples. So let's dig in. Let's start with a quick example. There are a total of 1,000 students in your city for class 10. You want to bet on one or two students who would perform better in the final exams. Which means you need to choose that one or two students who will perform the best in the final exams. So what do? You look at the profile of each of the 1,000 students, analyze many factors like their scores in the internal exams, quarterly exams, their scores in weekly assignments, and perform various academic checks and due diligence on their profile. How tedious is that? You have a job of your own, a family to look after, many other commitments. On top of that, you don't have knowledge as good as the top-notch professionals or experts out there who are very good at executing such due diligence. Still, you tried your best, did your analysis, took the opinions of many people, and zeroed in on the top best two students who you think will perform the best in the final exams. You bet 1,000 rupees on them both. Sounds fair enough. Now what? The final exams are here. But one of the two students you selected is sick and hence unable to perform well in the exams. The other student faced some science questions in the exam which he didn't prepare well. Unfortunately, the two students couldn't perform well. They delivered below average performances and you lost your bet. Very sad. The next year, you bet on two different students and got an average performance from them. The third year, you again select two students and they performed below average. The fourth year, you're tired of doing all this, have time constraints because of your work pressure. Hence, you decided to hire someone. He is a professional to do this analysis for you. Great. This professional is an IIM graduate, well-read and post-graduated from Harvard. He charges you 2% of your investment. No matter the investment fetches returns or not that year, his charges have to be paid off, right? He toils a lot with his analysis. His time is valuable. Hence, you pay him 2% of your betting amount every year, regardless of whether the bet fetches you any returns or not. I know investment is not a betting game, but just for the purpose of this example, we are using the term. Also, he tells you that depending on the circumstances, he will change the selection of these two students once every month if he thinks they wouldn't perform well, or if he senses something odd about their profile. But to change these selections every month, he charges you an additional 1%. You agree with great hopes on his expertise and a deep desire to up your returns. Now, 10 years have passed. Voila! You look at the average annual return. The average annual return after deducting the charges of 2% and 1% come to 4%. You don't look satisfied, do you? Your mother's FD is giving you better returns after all. Now let's take another scenario. Your friend can't invest so much time, energy, and patience to analyze the student profiles, nor does she have that much money to hire a professional. So what she does is, she heard that the Lions Club of your city rewards students every year for their performances and gathers data of the students' performances during the year also. One fine day, she goes to their office and requests for reports of the best 50 students for that year. She then bets 20 rupees each on the 50 students. So, a total of 1000 rupees, isn't it? Now, the final exams results have come, and surprisingly, 30 out of the 50 students showed an above average performance. Your friend couldn't be any happier. She did the same thing for next year, reaching out to the office, getting a report free of cost, and investing equally on the top 50 students. Days passed, and after 10 years, she calculates the average annualized return on her investments. Surprise, she got an annual return of 7%. She thanked the Lions Club and decided that she will continue investing on the 50 students, the same as those listed by the Lions Club. This is a simple analogy for you to apply this scenario to a stock market. Let's say you hired a professional, pay him 2% to select a portfolio. He levies 1% extra as tax costs for selling and buying the stocks, shuffling the stocks of the portfolio. Totally, you incur 3% costs for your investment. And over a period of 10 years, you see that the returns are around 4 to 5%. You regret the costs you paid for a nominal return. On the other hand, your friend invested her money in a fund which invests in a set of stocks constituting what is called an index. An index basically represents a group of stocks related to a specific investment category. Say for example, there is an index called Nifty which comprises the top 50 large cap and liquid companies, the big companies like Reliance and HDFC. This index Nifty is basically a measure of the performance of such top 50 enterprises of India. Which 50 companies should be part of the index and which should not be is decided and reviewed semi-annually by the expert committees of the stock market itself. And the fund that your friend invested in charges her bare minimum fee because the fund is not actively trading the stocks and performing any analysis except for investing on the same lines as the index. So your friend's portfolio mirrors the index Nifty and it closely follows the index, which means when the big 50 companies perform well, the index fund Nifty performs well, and so does her portfolio, which closely mimics the index. Frankly speaking, her fund management style is a bit lazy. Let me put it this way. The investment strategy is passive, which means the strategy blindly follows the index, and whenever there are any changes to the companies or weightages in the index, her portfolio also simply changes accordingly. This portfolio, which mimics an index, is nothing but an index fund. To put it simply, this index fund is also a mutual fund which passively follows the index and gives you the same returns as the index. There is no cost involved in hiring those top-notch professionals to do the juggling of the stocks. Isn't that cool? Those set of companies in the index represent the whole Indian market at a broader level. But of course, there are quite a few index funds available just because there are many indices in the market. Which index to follow is up to you and your investment strategy. The concept of index funds dates back to Mr. John C. Bogle, the founder of the company Vanguard, that we discussed in the beginning of this video. If you would like to know more about the history of the index funds, click on this video. Now, we know that index fund is also another mutual fund that passively invests your money in a portfolio that closely mimics an index, which basically means that your investment vehicle is in autopilot. Now, let's quickly unpack each of the benefits. The first benefit is the low costs. Index funds don't require the extensive research, time and effort to select the stocks and actively trade them as and when needed to beautify your portfolio. Instead, the fund simply follows the index. Hence, they usually charge you very low fee compared to the actively managed fund. Let's take for example the top performing index funds in India. You can take a look at their expense ratios. Expense ratio is nothing but the percentage of money they take for managing your assets. These are the expense ratios of the index funds compared to a 2 to 3% expense ratios of actively managed funds. Of course, just because an index fund is low cost, it doesn't mean you don't exercise your caution and blindly invest in an index fund without looking at their fee structure and the kind of index it is based on. Second advantage is that by investing in an index fund, you will have greater diversification. Since you have your money spread out in many companies of the index, you are diversifying your risk, isn't it? The third advantage is that there is no human element. Human decision making and human emotions are taken out. The last advantage is that we can expect better returns. Index funds have given better and more importantly consistent returns over the long term. If you would like to compare other active funds with index funds, you need to look at the latest report given by SPIVA, S&P Index versus Active Funds Scorecard. Click here to know more on SPIVA. As per a latest report, 87.95% of the actively managed funds in India underperformed the S&P BSE 100 index. In America, 75% of the actively managed funds underperformed the S&P 500 index. If you feel this video helped you get an overall idea of index funds, just smash that like button and subscribe. I have more such amazing information to share with you. Have a good day.